Welcome, dear traders. You are watching a recap of the Asian session on September 11. Over the next few days, markets will receive important data from the world's major economies. Let's take a look at how the Asia-Pacific region traded today. In Japan and antipoding countries, stock markets started the new week with a decrease in the main indicators. The Asian indexes followed Wall Street on a Friday. US stock indexes experienced a losing week after the release of the statistical data in the United States. Notably, the unemployment claims in the US unexpectedly fell to the lowest level in more than 6 months. The index of business activity in the services sector, on the contrary, unexpectedly increased in August to a 6-month high. The reports showed that the US economy was coping well with the Fed's tightening cycle and signaled that it was ready for another rate hike. At least the Fed may keep the key rate at a high level for a long time, so inflation may cool down without the threat of a recession. Moreover, the US labor market managed to evade a wave of mass layoffs. This was announced over the weekend by US Treasury Secretary Janet Yellen after the G20 summit in New Delhi, India, Bharat. She said that the US would be able to control inflation without damaging the labor market. As a result, the US dollar and Treasury yields rose sharply last week. At the same time, stock indexes slumped. Meanwhile, the recovery of the Chinese economy remains highly uncertain. With a prolonged downturn in the real estate market, weak consumer spending and continued pressure on the manufacturing activity, China is a major concern for the region and the world. However, there are signs of optimism. Recent reports showed that China's consumer prices rose by 0.1% in August. The indicator is standing way below the 3% target. On the other hand, Beijing is starting to move away from a deflation. However, the deflation in China, falling prices due to weak economy and the labor market continues to drag the yuan down. It's a continued decline is forcing the Chinese authorities to spend their foreign exchange reserves to support the yuan's appreciation. Today, the yuan fell to a 16-year low against the US dollar. In response, China's central bank set the daily average exchange rate with the largest deviation in history. However, the yuan may face new challenges in the near future. After all, the Chinese authorities have so far only announced economic support rather than large-scale measures. In addition, China-US tensions have recently intensified. Last week, China announced restrictions on the use of the iPhone by government officials. The US dollar index retreated slightly from its 6-month highs in anticipation of the key inflation data, and notably the greenback's rally is the longest since 2014. However, as the fresh statistics could influence the outlook for the US interest rates, investors prefer to be cautious at the beginning of this week. Inflation data will be particularly important, as analysts are expecting a jump in prices due to rising energy. In addition, the fact that some traders prefer to close long positions in anticipation of the data may explain some of the decline in the US currency. In the Asian session, the US dollar fell in the range of 104.50 and 104.90. The index held near 104.60 at the beginning of Monday, and now the key resistance is located at the level of 105 points. This is the upper boundary from the beginning of the year. In the case of a further decline, may level of 103.10 and may offer support. Notably, the US seems to be the best performer among the world's major economies. The policy of the Bank of Japan seems to be undergoing some changes over the weekend. Bank of Japan Governor Ueda said that the central bank would be ready to start making decisions before the year ends. One of them is to end the era of negative interest rates. Since the yen pierced the key level of 145 last month. Markets have been on alert, waiting for any signs of forex intervention by the Japanese authorities. It seems that the comments of the head of the Bank of Japan have worked as well as the intervention. Today, the country's currency strengthened against the greenback by almost 1% and fell below 146. Amid the greenback's modest retreat from its 6 month highs, the dollar-yen pair continues to consolidate on a growing demand within the range of 145.80 and 147.80. Commodity currencies also showed signs of a consolidation in early Monday trading. Although oil prices remain near the highest levels since last November, they also entered the technical correction today. The fact is that the various supply and demand factors are at odds with each other. On the one hand, we see sluggish economic growth in China, and the world's largest importer of crude. That's a bearish factor. Against this backdrop, the US Federal Reserve may increase the key interest rate. This fact pushes the US dollar higher and puts pressure on commodities at the same time. On the other hand, OPEC production cuts should lead to higher prices. As a result, the Aussie dollar pair rose moderately, and today in the range of 0.6377 and 0.6445, and consolidated near 0.6440 by the end of the Asian session. The New Zealand dollar began to new trading week within the range of 0.5883 and 0.5934. At the same time, the Kiwi dollar pair is attempting to move away from the 10-month low it reached last week. Meanwhile, the Reserve Bank of New Zealand is expected to raise interest rates amid high inflation in the country. As a result, the Kiwi finished Monday's Asian trading session at 0.5920 with a moderate rise. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. Subscribe and see you online soon.